banking and finance. Um, it's my final year. I'm probably gonna head out of work. I'm still looking for a job, but that's for me to figure out. I've had at least 2 years of equity analyst hands-on training from internships and freelance work. As Simeon had mentioned before, I first started out my journey with him at a boutique firm, and afterwards I've moved on to various internships. Some of the notable internships are Maybank Investment Banking Group and Mercedes F1. So that was my last internship. I went to the UK for that. Uh, Whenever I'm not doing my internships or schoolwork, I engage in these hobbies, which is Brazilian Jiu-Jitsu, golf, and reading. Anybody here like reads, read fiction or non-fiction? Oh, nice. What books do you read? Oh, nice. That's good. That's good. Very useful if you're being an analyst, because sometimes when you're looking at certain companies, you want to understand the human behavior. So that could help you out. So these are the table of contents I'll be going through today. These are the first half of what I'm going through. Basically, I'll be going through the key components of what exactly constitutes fundamental analysis. So fundamental analysis is the key component to many investment thesis or like what analysts do. There's fundamental and technical and probably other many different forms of analysis, but these two are the main ones. After I go through the key components, I'll probably talk about nature of business. Like what do we look out for whenever we're looking at a business? Followed by approaches, bottom up and top down. I don't know if this is familiar to y'all. Yes, no? Okay, by the way, I'll still go through it. And lastly, due diligence, like how can we check whether the company is doing things the right way and whether they're doing anything illegal or fraudulent or suspicious. So for the next half, afterwards, I'll go through the more technical stuff. This might get a bit more complicated. If you understand, then that's great. But if you do not know, don't panic. It's okay. Just ask questions and I'll try my best to help you all along the way. So we'll be going through the quantitative analysis, which is the three-statement analysis, your profit and loss statement, your cash flows, etc. And what other resources can we use? Followed by qualitative analysis, which is more of like, what's the business model, the trends, and your other frameworks they can use to measure the qualitative aspects of the company. Comparative analysis, I think this one, maybe you guys are familiar, like Pesto. Yes? No?
Yes.
Yes. Okay. So I'm sure you guys know some of these methods already. I'll probably skim through that section so we have more time for the case studies. And yeah, so now I'll start with the key components. Maybe like gotta get some answers. Like what do you think are like the key components whenever you're doing an analysis of a company? Anyone? Maybe you? Do you have an answer? Numbers, like the financial numbers? Yes, that's one. Any more? Anyone else? Any ideas? Okay, maybe I'll go through. Maybe y'all are tired after lunch. But from what I've learned throughout my internship and doing some of these like analysis, I believe there are like three keys to the door whenever we analyze a company or a stock in general, or basically any investment. We want to understand the economic factors, like what are like the external and internal factors like affecting the economy, affect the business, followed by the industrial factors, like for example, you look at Grab, right? It's in a certain industry. How is it going to affect its profile, which I'll be discussing later? And thirdly, the business factors, the more micro aspect, like what is it doing? What is its expansion plans? What are their policies, etc. So to add meat to the bone, whenever we are having these three keys to our analysis also is that we want to find out these three items, which is the three statements. And I'm sure many of you all here probably heard of it before. Your profit and loss statement, your balance sheet, and your cash flow statements. This is like the bread and butter to all of like to all analysts. Like you need to be familiar with it and you don't need to know how to read it. So if any point in time you feel I'm going too fast or you don't understand, just feel free to raise your hand and let me know. But yeah, we know these three statements, we're able to get a better picture also of where exactly the company stands. And most of the time, these three details are in your annual reports or your quarterly reports of your company. So you can go online and find them, can Google it, ChatGPT, up to you. But there's so many sources out there to get this public information. So yeah, I have a QR code. It's like a Menti. Feel free to like scan it and then like give your answer. And basically answer which is why do we do fundamental analysis or why do we want to analyze a company? Let me pull up the Menti. Very slow, the Wi-Fi. Yeah, but the QR code is correct. Could y'all go in the QR code or cannot? Cannot go in, is it?
Wow, you open down.
Oh, that's weird. Okay, let me try that again.
Okay. I think you change that.
Why cannot? Sorry, guys. You try this QR code. Yesterday it was working. Does it work?
Still.
Okay, never mind. I think we'll skip this part. It's not so crucial. It's more of an interactive experience. Never mind, we'll just skip it anyways. But I'm sure many of y'all have like your own reasons. Like maybe someone can voice out like what's like one reason that you think why we do this analysis. Anyone? Maybe the gentleman over there. Do you know why? Like why do we analyze a company? Why do we need to perform fundamental analysis? Okay. Understand which part of it. Okay, yeah, that's a good answer. So yeah, we want to evaluate how the business works, but what exactly we're looking over there is actually identify and evaluate the true value of that equity or that business. We want to know what exactly is its inherent value. Like for example, let's take this water bottle for example, right? How much do you think this thing costs? Anyone? Voice out a number. 15? Okay. Sorry? Some Polo Ralph Lauren bottle. I got it. Yeah. I'm not telling you where, if not, then you get an idea of how much is it already lah. Yeah. 16, I heard 16. 60, okay. Anyone else? Okay. Basically, this encapsulates the whole idea of what investment terminology we call it intrinsic value. The market out there will always put a price tag onto the item, but the key idea is that we want to know how much this water bottle is really valued. I mean, to me, this bottle is very valuable because it's given to me by my mom. So probably the value is higher than whatever you guys are putting. Like, I mean, probably priced at like $1,000. I'm going to pay $1,000 for this bottle, but the market sees it as like less than that, and that's what we want to find out. We want to find out what is the true value of the business. Sometimes what the people say is exactly not true. It might not be the true value of business, and that's why we perform fundamental analysis. And using that information, right? Like let's say, for example, you know that I'm going to buy this bottle for $1,000. Maybe let's say you found it somewhere and then you want to sell it back to me because you found it lah, right? Then you price it at $60, but then deep down you know that I value it at $1,000. You want it to sell higher, right? You want to get a profit, right? All of us want to make money. So that's the whole idea of the buy low, sell high thing that everybody always says. And this is why we do fundamental analysis. We want to find these opportunities and finding this hidden gem. I don't like using that word, but yeah. Yeah. And we also want to analyze which equity best fits our objective. Everybody got different objective whenever we want to invest, right? Like for example, some of you guys maybe want to invest because you want passive income. Some people invest maybe because I don't know. Sometimes when I'm with my friends and I invest, I feel I'm a gambling addict. Like, I need to find the next big thing. I need to get a lot of money. But yeah, everybody has their own tastes and preferences. So we want to analyze and see if that fits our goal. And before we even dive into analyze, right, the very first step is understanding what is the nature of business. What is the business doing, right? Anybody here knows exactly, let's say, for example, whenever you look at a company, what's the very first thing you should be thinking about? Anybody here knows? No? Is it the finance? No. Is it where is it at? Like, where is it located? Is it the number of customers? The number of people buying or the share price? Anybody? Sorry? Brand name, reputation. Okay, that's one. Anybody else? Bottom line. Okay. Anything else? That's the correct answer, actually. I'm not saying your answers are wrong. They're good, and that's what we should also be considering. But before you even go there, you need to know what they're doing, what they're selling, right? If it's a service, if it's a good, we need to understand what exactly are they providing. A business is in the economy to provide something for anyone. When we can understand that, we understand so many other things, like how do they work. We need to understand how they function. And that's the job of an analyst. We want to dive deep into the nature of the business. So basically, the secret sauce to all of the fundamental analysis, I mean, in my opinion, after doing it practically, is understanding this basic concept of 5W1H. Anybody here knows what is that? You know what is it? What is it?
Who, when, why, what? Wait, who,
Yep.
when,
Where? Why?
what, where, and how.
Yeah, that's good. Yeah, that's a basic guiding principle of like the very basic view of when we're analyzing. You want to understand who is the target audience of the business, who is in charge of the business, what is the business about, when did this business come in, where, why, and how. These basic questions, right, allow you to give you a good picture of exactly what is the nature of the business and what they're doing. And all of the approaches, be it you want to do like a model, a financial model, or you just want to do a simple basic bottom or top down approach, it all hinges on these basic questions. And being an analyst, it's all about asking questions, right? If you can ask these questions, right, you get more clues. It's like you're being a detective, you're trying to find all the clues. And when we ask all these questions and we get our answers, it allows us to see how their margins are like and what exactly are the qualitative factors affecting these margins and how can we project and evaluate whenever we analyze them. Sorry. So here are some of the common business models. There are many out there. People have their own way of terming them as well for each specific business. But generally, if you go online or if you read articles, they'll usually use the terms like B2C, B2B, multi-mix, not really, but I did see that once or twice. Fee for service, subscription. Yeah, anybody knows any business model that's a subscription basis? I'm sure you all do. Anybody? Name one? Netflix. What else? Spotify. Anything else? Okay lah. I think maybe lah, maybe. Or like your YouTube Premium. Yeah, that's like a subscription model. Then we also have a manufacturer model and a retailer model. So far, any questions here? Feel free. No? Okay. I think this one is quite straightforward, but when we understand all these business models, it gives us a glimpse of how to answer our who, our what, and why. Right. Regarding the why, I think just to dive in a bit deeper, is that whenever we look at these models, we have to understand why are they serving these customers. Right. For example, you look at Netflix. Why are they using this business model to serve their customers? Makes sense. So why are they using that model, right? I mean, I'm not asking you all to answer the question, but that should be the type of question you should be asking yourself, like, why did they pick this? Is there a reason? And does it work for them? Right. So what else do we also need to figure out besides like the business model? We also need to understand which industry and sector they belong to. So I have a quick question for everyone. Do you think industry and sector are the same? Anybody? Do you think they're the same? No? Okay, I have one no. Anybody else think it's the same? No. Okay, yeah, they're not the same, right? Just for information. Industries are more broad. Industry is usually a broad term, and then sector is usually the micro term, if I remember correctly. Yes, but should be along the lines of that. They're not the same, right? So we need to know this to distinguish and also know how exactly they can affect our analysis. Next is domicile of operations. So domicile operation means where they are operating. Like for example, if you look at Grab, they're listed in the US stock exchange, if I remember correctly. But the most of the time they're operating in Southeast Asia. A lot of their major operations are in Southeast Asia. So basically, we need to know where, because if you're listed in another country, yes, it affects it, like the share price and all that, right? But the core business is still in Southeast Asia, for example, for Grab, right? If everything is being affected in Southeast Asia, right, and you're just solely only looking at the US side, it's not going to work. So yeah, you need to know where exactly they're operating. The next is the competitors. So obviously this one I think is quite straightforward. You just need to know who are the players in the market, who are potential entrants as well, and followed by the macro and microeconomic factors. Have you guys take any economy modules in poly yet? Yes. So I think this one quite straightforward. And lastly, we want to understand the historical data of the management and governance. So what do I mean by that? Basically, it's more of a compliance side, which I'll later dive in more. And before I go on, one last check in. Any questions so far, or everybody following? Everybody following? Okay, good. So right now I'll be talking more about the approaches. So what do I mean by approaches? Before you even go to like all the modeling, you need an approach. Like how are you gonna put on an optic or a lens to look at the company from maybe like a distance, right? Usually many people will think about approach like, oh, like I just look at general, like I just use pastel or whatever and just whack it in. But actually there's something else before that you should even dive in, which is more on which of how are you gonna view it? Are you going from big to small or small to big? So what do I really mean by that? So what I meant by that is that there's two basic approaches, in my opinion, that I commonly use. The first one is a top-down approach. So it's like more of like a funnel. I think this was one of the basic ones that Simeon also taught me when I first did my internship. So it's like a very basic approach where you start off with the economy, the sector, the industry, and then the company. Sorry. Just to clarify, I think I say wrongly. Sector is the broader term than industry, my bad. But usually what this funnel means is that we start very broad on how the economy affects the company, and then we dive in deeper and deeper. By the time we hit company, it should just be purely how what are the specific factors in the company that affect the other ones as well, and what is it that is like the micro things, the tiny little details of the company, how they spend, how do they manage their debt, those type of stuff. For just some examples of a macro factor could be like interest rate, your GDP. And micro is more like sector specific, like tech sector, like what is the trend going on? What's the biggest problems going on there? Hi, hello. Welcome, take a seat. So the other approach for me, like I personally use this more, and I think would be useful as you guys probably go on your journey, like on your finance journey, would be the bottom-up approach, because I feel that it's the inverted funnel, and you really get to compare the economy. For me, I don't know if any of you all know this term called value investing. Anybody knows this term? Yes, I'm sure some of you maybe know. But basically, it's like I want to find high value stocks, things that are stable. And sometimes like I do play growth stocks as well. Lately, I've been doing more growth. So I tend to adopt this method more because I want to look at how the company is against the economy. I want to find that hidden gem I've been talking about. So usually when we use a bottom-up approach, right, we're looking from a company point of view. That's the broad one first. Then we zoom into the industry, like how is the company fit in the industry and how does it compare with its peers and all that, followed by the sector and the economy. Like, is it doing better than the economy? Most often times it won't do better than the economy in what we call like the theoretical framework in investment. You cannot beat the economy. Usually they're slightly below the economy, right? But once in a while, there's always outliers, and we're here to find the outliers usually when we do fundamental analysis, right? When we find these outliers, that's where the true value is at. We get more money out of it. It's like Chinese New Year. Anybody here play like blackjack? You know?
Yes.
All right. You play blackjack. Let's say you get like a 11. Are you gonna bet? You know?
Double.
Correct. That's right. 99% of gamblers quit before winning big, man. Okay, please don't gamble. I'm just kidding. But the idea is that when we look at like these growth stocks and when we compare the company against the economy, it's essentially that we want to see whether do they have the potential to beat the economy and get more out of it. I mean, you double, obviously in blackjack, you're gonna get more luck, right? You're gonna win the banker. That's the whole game. That's the idea of from the bottom down approach. But it's a very individual process. So there are some flaws up for sure because it's very sometimes it can be seen in the vacuum and you might forget the external factors as well. And sometimes it's a very heavy focus on earnings and metrics. You might forget your qualitative aspects. So qualitative aspects are very important when you're doing your analysis as well, which I'll go through. So just to dive in deeper on the bottom-up approach, usually we'll start at the company level. We'll do more of the three statements just now I was saying, the profit loss, your balance sheet, and your cash flow. Usually, These three are like you have to always zoom in whenever you look at a company approach, followed by your earnings, your margins, growth. Growth is one of the most important. Unless you want to buy like a stable stock that issues dividends, then usually you won't look at that too much lah. But most of the time, growth is always something you want to focus on. If the company is not growing, they're not using their money wisely, and if they're not growing, something is wrong. Right? You should signal to you there's something somewhere is off. The next is also the financial metrics and ratios, like your P ratios, your EV over EBITDA, your price to book. These may sound a bit unfamiliar, but if you do not know, you can like just Google or ask ChatGPT. I'm sure they'll probably give a more comprehensive answer than I could give. And lastly is the expansion plans. What are their plans for expansion? This relates back to growth. Like for example, I think what is a good stock that you all would know? Let's say, for example, anybody here buys any stock in Singapore or US? Anyone? Yes, what do you buy usually? Yeah, what do you buy? Sorry? Valentia. When you buy Valentia, do you Valentia. Wow, it's not tough. Can't really give a good one. Okay, never mind. I'll maybe bring in another one. Let's say DBS. I'm sure most of you all know DBS, right? If DBS doesn't have any plans to grow, would you buy? No, because it's going to stagnate. You're just wasting your money. You're better off finding it somewhere with better expansion plans. That's the key idea for the company aspect and the company level. You want to find expansion. You want to find what is their strategy, and this gives you the qualitative idea as well. So many of these can be gathered from their annual or half-yearly report, sometimes quarterly. For Singapore, there's no mandate to do quarterly. It's always half-yearly and annual, just for your information. So the after company, we usually dive into the industry. So industry is like, for example, let's bring back the water bottle again, right? The water bottle industry, there's so many players, right? Well, how do we know whether the company is performing well against from an industry level? Usually we look at the industry GDP, right? When you look at your overall GDP, you can find out what are the sectors of GDP that are affecting it, right? When we find out the industry GDP, we also want to calculate their historical growth most of the time. You want to know how well are they doing right now. And that's what we do at the bottom-up approach, followed by the peers that are operating. Are they doing well as well? How is their margins looking like? Right? This is what we call comparables, followed by trends. Currently, I would say, what's the trendiest thing now? Let me think. AI. I mean, I don't know what other trendy things you guys do or not that far apart from you all, but usually I'm only 20, but either way, the trends, right? What we look at, right, is things that are catching momentum, right? Your AI, your what else is there? Your EVs, right? All those type of stuff. That's why we see where's the industry trend going towards. Is it on a hype train or whatever, or is it on a downhill like a sunset? After we look at the trends, we also look at the stakeholders. Who are the major players at play? I think this one is the more interesting ones because sometimes these stakeholders, they could be political, they could be hidden, and you wouldn't know. That's the hard part about the analysis. You gotta like make certain assumptions like how is this gonna affect them, and you put yourself in the shoes of them on how they think. Like for example, Elon Musk, right? He's a stakeholder in the EV industry, right? So what does he have to gain if he were to be part of this presidential election? Those type of thoughts should be in your head when you're looking from an industry level. You want to see how these stakeholders can affect the industry and how the industry can affect the stakeholders. And then you link it back to the company, like does it have any effect on the company? Next is sector level. Similar to the industry level, is the same thing. Again, look at the GDP contribution. Is it a big part of like their domicile of operations? So let's say you're looking at company A and it's maybe in the tech industry and it operates in maybe like Lithuania, for example, right? But Lithuania maybe doesn't have a very good its GDP contribution from tech isn't a lot. So therefore, you would then think, okay, if the GDP of Lithuania goes up, right, would it have a very big, sizable impact? Most likely not. The answer is no, because it's a small portion of the GDP. It's not the one driving the GDP. That's where we look at the sector. Afterwards, we look at sector relationships. So this one is more like an economic theory already. I think many of you all do know. Like for example, water bottle, right? What are the parts? Metal. So you look at metal industry, rubber, then you look at rubber industry or petroleum industry. Those type of things. We want to look at the symbiotic relationships and the parasitic relationships and all that. Then same thing, trends again, we want to see how the trends are like. followed by the nature of the domicile. Like, how's the nature like? Is it seasonal? Is it cyclical? Is it very exposed to volatility? Like, it's very volatile. Like, for example, tech industry, it's whenever there's a recession, it's the first one to hit. Whenever there's boom, it's also the first one to hit. These type of things. And the last we'll look at is economy level. So usually we'll look at the policies. So who here thinks this one is the most important, like economy level? Or is it the company level is more important? Economy level. Okay, yeah, I would say you're quite right. I mean, obviously everything is important, but economy level is one of the most important. Why? Why is it important? Anybody got an answer? Okay, that's one answer. What else? Anything in particular that you think will affect your investment decision or affect the company? Anything? What do you think in the economy level is the most important? Someone say what? Sorry? Interest? Interest rate, okay. But maybe think broader. What part of interest rate? Like what affects interest rates? Correct, that's the answer. Policies. That's the reason why it's one of the most important factors that we need to look into. Because a change in policy, let's say, for example, TikTok. Government wants to ban TikTok, no point investing. It's going to lose money because they're out of the market, right? These type of things. That's why we want to look at the economy level and link it back to the company level. We want to see how does the policy affect everything. If the policy changes even one minute thing, right, it can affect the company a lot. And the company, most often times, the business owner or the company is unable to control the policy. The policy is all dependent on the government and how the people vote in, right? That's why we want to look at the policies and the intricacies of it, followed by the political risks. I think this one quite straightforward given the current climate. And the third one is the GDP of the related parties. So same is roughly similar to the sector industry. We want to see how the GDP correlates with the company back again and see whether it can outperform the GDP or the economy in this case. Like for example, if right now we're in a recession, right? For example, you find a stock that is still growing, still making a lot of money. It's like a defensive stock. Would you buy it? Yes. That's a clear answer, right? You would buy it because you're still gonna make money. So these are like the type of analysis we look at. We look at the situation and we see whether the stock is outperforming in those situations. On the flip side, I mean, if you're trying to short a stock, which I highly suggest against, then you look at the other way around. Yeah. So yeah, at the economic level, we want to compare how well will the company perform against the economy and its peers as a whole. So another one of the approaches, now I'm diving into a bit more technical. So if you feel like it's a bit too fast or very complicated, we can slow down. See someone laughing already. Yeah, this is painful. Anybody here after poly plans to go to study business in uni? You're gonna do this for three to 4 years, just to warn you first. It's not fun. I just had one this morning. I don't know what I'm doing. I'm losing it. I'm losing hair. I'm 23. I'm balding already. Okay, jokes aside, we'll look at the quantitative and qualitative approaches. There's a lot out there, but for today, for this workshop, I'll mainly focus on the DCF. I'll briefly touch on DDM and IPO, which I've done before, but they'll be very brief. But I'll still provide resources for you guys. That is from a professor in NYU Stern Business. I did. Yeah. So I did attend one of his lectures before, and one of my friends got a link to his website that he does all his modeling. So you guys can actually use that, take a look and use it for yourself. If you're going for case comms, you could use it, but obviously don't let the judge know you're using his model. If not, you have a lot of problems as well. But yes, that aside, there's also EVA comparables. I would say comparables is a quantitative approach, but it's usually paired in with the rest of them. It's like a little section by itself, but it still fit in with the rest, like a Lego block. So for qualitative approaches, I'm sure many of you all seen this before, like SWOT, Porter's 5 forces. I think maybe one that you all maybe never see is first principles. Anybody know what's that? First principles thinking.
Feedback, never learn, man.
What
Yeah, I think some of you maybe know, but for those who don't know, I'll go through in depth. But I feel this one is one of the most important things I've learned when I was working out in the real world. So oftentimes I think many of y'all, when y'all are like studying, y'all think, will this even be applicable in the real world, right? And I would say this one is one of the most applicable. And there's also another method which is called Occam's razor. I think maybe people who read psychology or do any of those probably heard of it before. Next is management evaluation. This is more of a compliance side. Then there's stakeholder analysis, which is similar to what I've mentioned, where we want to know what are the stakeholders involved, the buyers, the sellers, etc. And life cycle analysis. This one I'll touch briefly. You can probably read up more on your own. And the most important when we look at all these approaches is we need to know what to use, right? But all of that is dependent on the nature of the business. That's why we need to know the nature of business, because it dictates how we approach our analysis. And obviously, we also do the bottom-up and top-down approach to understand the situation and the possible angles. Most important as an analyst is, or if you want to be an analyst, is having flexible thinking, because there's always more than one angle. Let's say you play poker, you have 7 deuce, right? I don't know why I'm using gambling all the time. I'm not a gambler, okay? But the idea is that you need to have like flexible thinking in seeing the possible routes that you can take to get the objective that you want. And that's what all of our approaches are about. We want to know what are the possible angles and what can be used. And the list is non-exhaustive lah. So before I move on to due diligence, any questions so far? No? Cool. All right. Am I boring y'all, or am I very monotonous? No? Okay, cool. Yeah, for due diligence, before I begin, I think the general principle is better safe than sorry, right? We always want to be careful whenever we invest. It's very easy to overlook this because it's very wordy, it's very boring, very dry. But this is actually the thing that determines how much you're going to get and how risky it is. It's the qualitative aspect of risk. And the thing about risk is it's very dependent. Like, for example, okay, let's say I give you a coin toss. You have a 50-50 chance of winning like a Lamborghini Aventador, right? But if you lose, you have to sell everything that you own, even your house. Will you take it?
Yeah.
Okay, you'll take it? You will take it,
Yeah.
Because it's lucky, yeah, okay. You will also take it.
Yeah.
Okay. Who here wouldn't take it? You wouldn't take it. Will you take it? Yeah, you. I'm looking at you. Will you take it? Okay. If you have a 50-50 chance, like a coin toss, you get a Lamborghini or the car of your dreams. And if you lose that 50-50 coin toss, you lose everything you own, your house and everything. Right? Would you take it?
Yes.
Okay, we got one yes, no, yes or no? No. Okay. This is the whole idea of risk. Everybody got different appetite. Some people, like me, I don't know what's wrong with me. I want to take the risk. Some people don't want to take the risk. But that's why we do due diligence. It's so that we want to understand whether it's very risky or not, and whether it's within our risk appetite. So that's the key principle. So, sorry, just recover from a cold. How do we infer when we do not have direct information? Like many of us here, you don't know the CEO of the company that you're trying to buy, or you don't have any direct information, right? How are you going to infer that, right? Is it the news? Is it annual reports? Or is it you ask around your friends? Like your friends say, the CEO going to do this, he's a solid guy, can one. You probably will believe him, not right? But that also won't be that accurate. The problem here is that it becomes too general, and most often times it does not really show us the true picture. Like for example, let's say I own a company, right, that sells maybe software as a service. I tell you A that, oh, okay, hey, we're gonna do this, we're gonna get some Indonesian clients, we're gonna get some Malaysian clients, we're gonna expand. Our expansion should give us a good revenue of maybe $5 million, right? Would you believe me? Let's say I'm a good friend of yours. Would you believe me? You would, right? But then in reality, what I do is the exact opposite of it. I take on so much that end up I lose $5 million, and you're maybe like my big investor. Then suddenly I ask you, hey man, I need money, or you need the money, you come and look for me, right? That's the problem. That is very risky. So we need to sometimes make our own judgment call, and we need to realize whether what they're saying or not is true or false. right? Whether it matches with their actions. Most often times, I think later on when I'm going on with my case, you'll realize that sometimes what companies say to you that, oh, it's gonna be good, it's gonna be huge, that type of thing, right? Like Trump, if he says it's good or huge, you don't know whether it's true. Sometimes you can paint a picture that's very rosy. And we need to put on our detective caps, and we need to find the trail of breadcrumbs. We need to do a little bit of investigative work. To me, this is sometimes like the fun part. If you are being an equity analyst, you get to interact with many different people and you get information. If you're an introvert, it can be a bit tiring, I have to admit. As an extrovert, then this is your favorite playground. You get a lot of information, you talk to a lot of people. The news annual reports and the people around you, they are important, but they don't solve the full picture. We need them because we need the context. Like, for example, I give you a puzzle, like a jigsaw puzzle, right? What's the first thing that you would do? Anybody? Honest? Okay, that's one. What else? Anybody here will look at the picture first? You look at roughly the picture, you look at the color. Yeah, that's one. You have something to say? No? Okay. So that's the whole idea of context. You want to find the determining points first so they can work towards, right? And that's where news, annual reports, and track records give us an idea. What I mean by news and annual reports giving us an idea is that sometimes the news will announce like what they want to do, right? Then we keep that down, and then we check maybe like in the past or maybe later on, we check if they follow up what they say. Like for example, some of you are dating, right? Your boyfriend or girlfriend tell you, hey, I'll bring you to this place. End up 2 weeks later, never bring you. That's what we want to check, whether there's consistency in their answer. Next is the annual reports also. Sometimes companies say, oh, we are very sustainable, we want to do all this. We want to make sure that we're not going to release a lot of greenhouse gas. And then what they do, dump 1,000 kilos of like, I don't know, some chemical into the water. Those type of little details you want to find. You want to find those intricate details into seeing whether there's inconsistency in their answer and whether you can trust them. And the next is obviously track record. If you have a CEO who has been fraudulent, or like let's say you have you have a company, right? Anybody here know who's Jordan Belfort? Okay, maybe some of y'all know who's Jordan Belfort. He's the Wolf of Wall Street, big scam artist, fraudulent guy. He maybe runs DBS now. Will you trust him? No? Anybody here would trust him? Okay, good. Please don't. Okay, anyways, that's the idea. You want to see what their track record is. Is it true or false? Like, are they like trustable? Do they know their stuff? If let's say you have a CFO and you put some guy who's not finance trained, you're just gonna be shooting yourself in the foot. It's not a good company to invest. There's no governance, there's no due diligence. And the next is, in fact, I would say this is the most important, is how are their accounting practices done? Does it make sense or not? Are these numbers artificially inflated? For today's exercise, we probably won't dive too deep into that. But I would say if you have a free time, please go and take a look, because most often times, accounting is very boring. I admit, I also don't like studying for it. But surprisingly, it can save you a lot of trouble whenever you start to invest bigger and bigger. I personally knew someone who invested about 5 million into a company that basically, it was a private company. It was I call it those multi-level farms. It was in Singapore. So what happened was that he pumped in 5 million. The accounting practices, they overinflated the numbers and they didn't really show exactly how much that they took. They basically defaulted their credit card, head to bankruptcy. Guy lost 5 million. And the guy was also good friends with the owner. And yeah, the Singapore government also pumped in some money into this farm. So yeah, it's very important to know the accounting practices. You might not feel it now, but as time goes on, this would be, I would say, is the not bread and butter, the key to everything. The red flag, you want to find the red flag, right? So let's move on to diving into like the board members, the thing I was talking about, analyzing who is the person and all that. So how are their board members are structured is very important, and this will be evident later in some of the case studies that I'll share. So the first thing you should be asking is, are they signs they have worked together before? Let's say in this room, right? You all need to do a group project. Right? You need to maybe run like a mini company. If your group has all worked together before, you would think it's good, right? Yes. Anybody here think it's bad? No? And nobody here thinks it's bad. Okay. Sometimes it's good, but sometimes in a company setting or business setting, it's bad because it creates like a herd mentality or like a agreement mentality that if one guy's bringing his kaki, he just say, hey, let's do this. Who's gonna object him? Most of the times they won't, right? They'll just follow him because you're my friend and all that. This complicates a lot of things. So you need to see their track record, like which companies have they been in before, and then like you compare like hey, did they at the same time like go to the same company and that thing? Is it possible they know each other? Those type of questions you should be asking also when you're analyzing. The next is also poor diversity or lack of definition. So what I mean by poor diversity is that let's say your group, it's all filled with finance people. Is that a good thing? No. Why is that not a good thing? Yeah, correct. That's the key idea. You need multiple angles, right? And when you're running a company, same thing, you need multiple angles. Sometimes you'll overlook certain things, and that's a very big red flag, right? Lack of definition. So far I haven't met this problem, but I've heard from some other people who are working in the industry where the management doesn't clearly define what is the person's role. There's a dental company that I know. Actually, no, I do know this. There's a dental company that I know. I won't say the name, but basically what they do is that they bring their own family members into the company. They somewhat define the role, but it also sometimes don't make sense. Like the role is not needed, not necessary. It's not clearly defined, right? Like you already have a CIO, and you bring another second CIO who kind of does the same thing. There's no point. It's just burning cash, right? These type of things you need to realize that there's a sizable impact in your analysis, and it can affect your investment as well, right? The third point, too many finance rule. I think I went through that as well. It's not necessary all the time, unless you're a bank, but sometimes banks also need to have some diversity in the angles that they look at. And lastly, the lack of independent board members. Anybody know what the independent board member does? Anybody? Like, have you heard of this term before? You heard of this term? Do you know what is it?
Right.
Okay. Any other thing that they do? Let's say you're an investor of a company, right? There's an independent or there's no independent board member. What would be your thought?
Yeah.
Why?
Right. People point of view.
Okay, maybe think deeper. They provide what type of point of view? Who are they representing? What else? It's okay if you don't know. You can say I don't know. It's fine. No. The key. Sorry? Correct. That's what you want to look out for, right? The independent board member, right, is to represent the shareholders, which is you. If you got nobody representing you, and the management just say, hey, you know what? We're not going to give you dividends. We're not going to give you anything. What are you going to do? You can't do anything, right? There's no power. There must be some power balance whenever you're investing in a company. Well, I don't like saying it. I sound like a fin bro lah, but a lot of fin bros always say this: maximize shareholder value. You hear this a lot in uni, but it's very true, right? The reason why we focus on the shareholders is because when you invest in a company, you're the shareholder. You need someone there to speak up for you. You can't have a lousy independent director as well, and that's why we want to make sure there's at least one independent director so your interests are taken care of, right? In theory. But sometimes it doesn't work out that way lah. The independent director sometimes could be in cahoots with the board members. So you also have to take note of that. I think as I go on, I think most of you all realize that it starts to become like a chess game or like a poker game where you're guessing what exactly is the management thinking most of the time. So the next is also like how's the company's HR and welfare. Now this one is very highly overlooked. Who here thinks like when you're analyzing a company, HR is like the last thing on your list or should be like somewhere in the top three? Who here thinks that it's the top three? Raise your hands. Any hands? No? Or the last one? Anybody think that's the last thing you should be worrying about? Okay. I'm sorry to tell you this, but HR and welfare is very important. I used to think that way also, that it's the last thing that should be on my mind. But after going through some internships, I realized that that's a very important aspect actually. It gives you an idea of how efficient their workforce is. So anybody here watch F1 or like F1? Right, you like F1, right? Do you think they are very efficient company? Like the people, like the teams, are they efficient? Like they work like very smart? Like they know what they're doing, their HR and welfare is good. Yes, right. And generally you have a good impression that everybody there is like happy, they love what they do, right? That's actually a very good indicator, and this is something that you should take note. Because if a workforce is unhappy, the last thing you want is that everybody leaves the company. Your bottom line is affected. That's why I say like HR and welfare is highly overlooked, and it should be somewhere in the middle or the top range whenever you're analyzing. It gives you an idea. If a lot of people say like a lot of bad stuff about the company culture, all that, that's also a bit of a red flag, right? And we want to focus, if they have a heavy focus on compensation structure solely on the directors, and they have a very vague definition of their compensation structure, this also gives you a red flag, not just from the workers' point of view, but also how they're using the money. The money could be given out as dividends, end up they pay their directors instead. Right? The directors maybe getting paid millions already, get paid even more. So you need to take note of these type of things, especially whether they have done their HR and welfare structure properly. So the other thing that you want to take note of is how the company performs checks. So there are 3 points. The first is it internal or third party? Who's checking them? If it's own self check, own self, that's also a bit of a worry. But sometimes they do that because the nature of their business is very confidential. The next question you want to look at is also how comprehensive are their governance checks, like, and all that, like how broad is it or how deep do they go? Do they really audit fully? If they don't audit like fully, they don't really list out any proper definition. If there's no good reason why they don't do it, like if it's not cause of confidentiality reasons, then you need to ask yourself, are they like really knowing what they're doing? Like, is anybody doing a check and balance? And the last is any history of whistleblowing and other incidents. I think this one is actually one of the most important because like, let's say Boeing, right? You whistleblow, you're gonna disappear, you're gonna die of a heart attack, but maybe someone kill you, who knows, right? Those type of things, right? Whistleblowing is a very big indicator that the company is being run inefficiently and your money is not, the money you invest in is not being spent properly. So I would say these are the type of analysis that you need to take note of whenever you're looking for the breadcrumbs. So some of these notable cases, I think, anybody here knows what's high flux? No? Yeah, Oliver Lam. So basically, long story short, this company, the director was like a one-man show. She decided to control everything and then like call the shots. Nobody there to stop her. They had they wanted to expand and it was very capital intensive. They took on too much debt, sorry. And as a result, they got bankrupt and they had to delist, people lose money and all that. It became a fraud. They pump up their accounting numbers. In fact, that's the most important. They pumped up their accounting numbers to make it look rosy. That's number one. Enron, anybody know Enron? Yeah, what happened to Enron? All right, that's another one, accounting fraud. This one I'll probably explain. I don't think any of you know this. This is a Malaysian subsidiary company, Charles Wood. So same thing also. This one quite funny lah. I think when I was preparing, they also had accounting fraud, right? They pump up their numbers and all that stuff. But the biggest thing, I say that there's nobody stopping them also making dumb decisions. This is a food company. So if you are a food company, what would you acquire? Let's say if you have money. You will acquire another food company, right? Or what else will you acquire?
Factories.
Factories. Okay. Right. That's the logical answer, right? And if are you in debt, will you acquire?
Maybe.
Maybe. Okay. Okay, fair. This company decided to acquire, guess what? Anybody here can guess what did they try to acquire? Sorry? Huh? No, they tried to acquire a battery company. Food and battery. How do you combine food and battery? Right? Nobody would dare to tell them that that's a bad idea. And they were in very big debt. Right? They didn't manage their accounting properly also. And last one is Lehman Brothers. I think many of you all know this one. Right? Anybody here don't know this? Lehman Brothers? You don't know Lehman Brothers? Go watch the show, the movie Big Short. I think it explains it very well. But basically, it's the '08 financial crisis. They took up subprime mortgage losses and all that, like CDOs and what was the other one called? Basically, what they did is that they took these mortgage bonds that were supposedly really bad, right? they are like triple B, like lousy rating, D, C, and all that, like lousy rating. And then they put them together in like a little pot, mix it together and make it like sound like, oh, it's really good, it's triple A. But inside it's all nonsense, right? And this will later help you with one of the qualitative framework, which is first principle thinking. And just a teaser, the quote that I heard and I still live to this day whenever I'm doing my analysis is, okay, this is the safe for work version. If it sounds like a duck, um, quacks like a duck or smells like a duck, it's probably a duck, right? So if someone is like telling you that, oh, it's a new thing, it's supposed to be better, but in the end of the day, it's still triple B's, triple C, or whatever lousy rating, right? It's still nonsense, right? So, and they also messed up their accounting numbers. They made themselves look really, really healthy. Yeah. So, what is like the common theme here? You all realize fraud. What else? What about the fraud? What about the fraud? Not really. I think yes, but what about the fraud that then the inside job that led to their failure? Like, what is it that if you were an investor back then, right, and you notice all these red flags, right? What is the thing that you would first double check? Anybody knows? Try any answer this. Just shout. It's okay. You know? No. It's accounting practices. All four of them is all accounting practices, lousy accounting practices and fraud. Right? They have management, nobody there to check them and all that. Lack of governance, and as a result, got all these funny cases. They're pretty meme, very nice to talk about. But if you're an investor, it's not nice to have it happen to you. That's why we need to make sure we check it very deeply. If not, we're gonna lose money, right? That's why accounting practices, as much as it's dry, right, it's very, very important to know and to understand how they do it. If there's even like a slight flaw where it sounds like they're trying to make themselves look really good. Most of the times, company, like when you all do your internship, your superior might tell you, it's okay, make it look a bit nicer. That's a very big red flag. That's not a good thing, right? Because it's hiding the truth. That's what we want to find out. So in summary, I would say whenever you're doing your due diligence, these are the three components. Firstly, obviously start with accounting practices, followed by the board member makeup and how they manage their risk, like their debt and all that, or their expansion plans, right? These type of three components helps you ensure that your due diligence is done properly. So I'll go to the heavier side now. How much time do we have left? Yeah, got time. Let's take a 5-minute break. The toilet. My throat is getting a little hoarse. So yeah, let's take a 5-minute break. We'll come back here and I'll go through quantitative analysis. Okay, I'm going to continue for the interest of time. So now I'll be diving into quantitative analysis. Any point in time you really don't understand, just raise your hand. It's okay. So yes, this is. Oh, by the way, when you go to uni, it's going to look something like this. It look very, very like funny. So a discounted cash flow model. Anybody here knows what's that? Anybody? So most of y'all don't know this. Is it? Do you know? Okay, yes, correct. That's what a DCF model roughly translates to. And this is the staple of every analyst tool set, right? We use a DCF model to really get a picture of the intrinsic value. So the intrinsic value, as I was mentioning in the start, was the true value of the company, how much it really is worth. And this is based off like I don't know if you all studied this yet, but something called like perpetuity, annuity, and then you discount cash flows back to get the present value. Any of you all know that? Yes, no? Yes, I'm sure. Okay, then you'll probably have know some of this already lah. But basically, for those that do not know, when you analyze the three statements, right, you maybe take like a 3 or 5 year historical, and then you project it, you check the growth rate and all that, right? Then afterwards, you're gonna calculate something called a free cash flow. This is the whole basis of the discounted cash flow model. A free cash flow is essentially a discounted cash flow, right? There's many types of free cash flows out there. There's unlevered, levered, etc. Right? And it gets very complicated. But for today's sake of conversation, we'll use the industry standard, which is called the unlevered cash flow, for your information. And this is the formula for a free cash flow. Do not worry, later during the case study, when you're doing the exercise for yourself, you can refer to this lah, like this formula. At any point in time, ChatGPT, Google is also your best friend. Feel free to use it if that suits you. So the next thing in the discounted cash flow model we are also looking at is the terminal value calculation. Usually we do 5 to 10 years. Some people do 3 years, depending on what's your objective, what's your time horizon. So the terminal value is basically the free cash flow in the final year, which is the present value, right, that you want to find, times 1 plus G. G is the growth rate of the, in this case, your equity lah, the stock. Some people use the economic GDP growth rate. There's many ways to look at it, right? But usually, for me, what I usually do is that I look at like the 3 statements. I take the growth rate and then I roughly guess which one is the biggest driver. I use that growth rate and I times it for simplicity's sake. For today we're just gonna keep it simple, but as time goes on, when you do your own journey, it'll get complicated. Then you like think which one to use and all that. That's also a concern. Then divided by R, which is the interest rate minus G. But that's the basic formula. Correct me if I'm wrong, anybody. Yeah, it's the WACC. X is the discount rate, right? Yeah. Sorry, R is the discount rate from the WACC. Anybody knows what's WACC? Or cost of equity? Yeah, weighted average, yes. Weighted average cost of capital. Yeah, later, please you can look up at the WACC as well, which is calculating discount rate. This is the thing that is the most important part for your cash flow. Your discount rate is off, right? The value you get for a stock don't make sense, right? It'll be very funny. It will make sense later also when you're doing the exercise. But for today, I provided the WACCs and all that for you all, and the discount rate. The other method that I've seen some people use is something called the exit multiple method. So the exit multiple method is basically you're using the EV or EBITDA, EV over EBITDA or EV over revenue to help you calculate essentially roughly the same things and the intrinsic price. For today, if you can't do this, it's okay. This is more for people who are familiar with the DCF already. You just want to try this, feel free to do that in the model. And essentially at the end, you discount the free cash flow back to the present value. You sum it up and add it to the terminal value for summary sake. But if you were to look, if any of y'all maybe remember the formulas for those who know, there's an infinity at the top, right? The reason why we take an infinity is because we see a business as a going concern. So that's one thing you need to take note. You have to assume the business doesn't end. Although in reality, it will end at some point. If it lose money, it will die, right? But if it doesn't lose money, you'll just keep going. That's what we call perpetuity.
Sorry, I don't mind.
Yeah.
I come here. So now this is a little bit more technical, so I thought I'd just give a little bit more color on this. This entire discounted cash flow model, right, is really borrowing the concept that $1 tomorrow is worth less than $1. Now, what does that mean? That means that $1 in the pocket today, I can spend it, I can use it, I can invest it, right, at whatsoever percentage, right, that the market is offering me. Right, and that will give me even more tomorrow. Whereas $1 tomorrow, right, I can't do anything with it today. Right, I have to wait for it to come tomorrow. Then only I can use that dollar then. Right. So this whole concept here, what it's trying to say, right? The dollar, how is it derived? It can be derived from things like your free cash flow. Free cash flow can take a form of free cash flow to equity holders, to the firm. So there are a few permutations to this, but suffice to say, right, each company basically has a cash flow. They are able to generate cash. Okay, if you cannot generate cash, then you are not exactly a very good company, right? If you are a fairly good company, you'll be able to generate good cash flows, right, on a yearly basis. And where Chun Hao just now mentioned, companies are seen as a growing concern. Now, those of you who have taken accountancy, accounting, right, accounting for business. One of the key concepts of accounting is that all businesses that we analyze are seen as growing concerns. That means we assume that they will be here next year. They will be here the year after, right? The moment we take away this assumption, right, a lot of our calculations will not bear fruit. Okay, so when he talks about the terminal value, right, this is assuming that all companies can survive into the foreseeable future. Okay, so that's a key assumption. I just wanted to share that.
I think also a recap for some people who are taking any module on that, right? But yes, I think also to add on to Simeon's point, is that for a lot of models, there's always something with its assumptions. We're assuming a lot of things. And then you might ask, in reality, sometimes these assumptions are unrealistic. Yes, we also cannot predict everything. But the assumption is to at least give us a somewhat guiding point or benchmark to work with whenever we're using models. So some of the biggest pointers also for discounted cash flow is that we have something called the sensitivity analysis, right? I won't touch too much on that because it can get quite dry and complicated, but you can look up on your own. But basically, is that when we do sensitivity analysis, we want to see how certain things like change and all that. We need to make sure our assumptions link back to the fundamental elements, which are the first few points I mentioned, all the basic bottom up, top down approach, all those stuff, those basic questions that you need to have answered already. And this also affects like your free cash flow model, your terminal value, and how you're going to project it in the future. So to put it in layman's term, whenever you're doing your discounted cash flow, you're taking all the positive, like as he was saying, you're taking all the future value of the money, you're bringing it back to the original value, right? You must have some assumptions, right? So some of the key assumptions could be like it's perfect capital market, investors are rational and all that, right? That's actually, in reality, it doesn't always work that way, but we have to use it. If not, we can't calculate. Right? It will make our math don't make sense. But when you're actually going to buy the stock, you also need to take note that not everybody is rational. Some people you hear like buy to the moon or just whack, don't care, don't look, just throw those type of things. So that proves the assumption wrong. But for sake of today, we just assume these type of things. The next is also we can also use a range of growth rates, and existing models out there can give a guide. So what I mean by that is that some more people might publish their models and all that, right? And if they're accredited, then you can refer to them if you have access to it. If you don't have access to it, then you obviously have to do a check lah. But there's always many other ways to look at it. The thing about modeling is no one model is the same as the rest. Whenever you're doing it. So these pointers, I would say they're more applicable in a real life context. The next is also always double check the tax rate, because sometimes the tax rate that we look at could be like, for example, from a certain tax bracket for the company, right? But it doesn't work for the company because they have tax discounts. This might sound a bit like technical, but the idea is that we want to make sure that all of our tiny little details, right, are accurate. Details matter, and the devil is always in the details whenever you're doing your analysis, right? So if you want to be an equity analyst, I would say you have to make sure you're precise and accurate. The next is also regarding growth rates or any other thing, right, in your analysis. You need to make sure that your time, how long is your time horizon? Obviously, if you have a longer historical period or you have a longer time horizon, it's more accurate, right? You got more data points to work with. But there's also a flaw in that as well. If you have a longer time horizon, right? What if you have outliers? Like let's say I'm analyzing a company, I bring it back to 2019. Do you think that's an accurate time horizon? Anybody? Why no? Right? Those are the outlier events. These can affect the true analysis of the company. These are the type of little details that you want to take note, and they can also affect your assumption sometimes. So the next other model is the dividend discount model. I'll touch this briefly because you won't do it today, but it's more food for thought. So basically, a dividend discount model, like how it briefly works, is you identify the historical dividend policy over maybe 5 to 10 years, map out the growth trends, and you pick the suitable DDM model. I won't dive too much into it. It can be a bit confusing. And then you calculate something called the cost of equity, which is your discount rate. Discount the dividends back. Basically, everybody here knows what dividends, right? Right. Basically, the company gives you like little percentage of income. You're discounting those income back, and then you plug it into some formulas to give you the value, your present value or your value that you're trying to find, and then you perform the sensitivity analysis to see whether the stock is worth buying. Usually for DDM, you're using it for companies that give out stable dividends, or what we call value stock, right? Maybe things like Microsoft, they give out dividends, or Coca-Cola, McDonald's, etc. Or DBS, right? Usually DBS use the DDM model, and they have the proper term for it is called the Golden Growth model. where you're assuming the dividends grow in a stable period of time. I won't touch that today. If you want, you can go online and look. There's a lot of resources out there to tell you what exactly it is about. The last one is something that I've done before, which is called the IPO model. This was something I briefly worked on and also learned when I was in Maybank as well. So basically, the IPO model, briefly, I won't dive into it because you need to have prior knowledge of the other two models to really get a better understanding of this as well. How it briefly works is that basically there's equity issued by the company. You want to find out how much equity they're issuing, the shares, the price, what's the price that they're setting at to buy. Whether do they have debt when they do this? Most of the time they do, because when you IPO, wait, everybody here knows what an IPO is, right? Yes, right. Okay, so basically when they list, they need to pay underwriting fees, they need to pay fees and all that. Sometimes they don't have enough money, they might need to take on debt, or they have pre-existing debt, right? You need to find out whether they can pay back the debt and cover the underwriting fees. No point if you list and then what happens if nobody buys your stock and you can't cover the underwriting fees. Stock goes bankrupt, you lose money. So that's roughly what the IPO model is trying to look out for. And then we have something called a pro forma balance sheet, where we're projecting like around 1 to 10 years usually. Followed by that, we most important want to know their cash flows, their inflows and outflows. How is money coming into their company for IPO models? So this one is something I would say, if you are in private equity or if you're in investment banking, you might see this very often, or different models out there lah. And afterwards, you find out the net cash after IPO proceeds. Cash is king, right? Whenever you look at companies that want to list, right, you want to find out how much cash they have. More cash they have usually is a good thing, but also can be a bad thing. It means they're underutilizing the cash. But when they have more cash, it means that they're in a healthy position. They have options. It's like you have good grades, right? It means you have more options, right? You can do more things, right? That's the key idea whenever we're looking at the IPO model as well. Then afterwards, we have the PE forward multiples. We want to know how much the PE is at. So usually when you're buying a stock, one of the key ratios that we look at is the price to equity. I won't delve too deep into that. I think some of you maybe learned this in your modules. And maybe some other ratios that like your debt to equity, etc. And most important, I think this one, if you're going to apply for internships in private equity or sometimes investment banking, you'll ask this thing called cash burn rate. If you can't remember anything on IPO model, at least remember the cash burn rate. This thing here, I've been asked at least 4 to 6 times for every interview question in an internship or a job, right? They will always ask you, what's the runway? How much money are they going to burn before they become profitable? These are the type of things that you need to like figure out. So the cash burn rate formula, I won't give it. You can go Google it, but you need to know, because whenever you're investing in a company or whenever your boss is asking you how long is the cash burn rate, they want to know how long do they need to wait before it becomes profitable, right? That's the key thing, because time is money. The longer you wait, there's more risk also. That's why I would say this is the one of the most important. And lastly, whenever you're doing any model, obviously have your assumptions. What are you assuming? What's the growth rate? Are you assuming perfect market? Are you assuming it's growing steadily? So some other pointers as well. I would say 8 general guidelines when I was working, I would say is number 1, take note of one-off major transactions. So many times, right, when we are looking at a company, right, we see one good news, right, we'll think that it will lead to like forever. It's going to make them like propel them forward. Like there's a good momentum. It's going to go forever. Any analysis, you always see this type of logical fallacy. So the problem lies here is that when you hear like a one good thing, right, it could just be one off and it might not really translate in the long term. Like let's say, for example, for ladies, right, you'll see a guy with abs, 6-pack, right? You think it's a good thing, right? It's like, wow, this guy is solid. But that's only one off. What happens when he's 40, he's 50 in the long run? He might lose those abs, he might get a dad bod, might get a beer belly, right? That's the key idea here, is that it could be a one-off transaction. The thing could be lost afterwards, right? So we want to make sure that we do not fall folly to that. The second is, are there stipulated and stable dividend policies? We want to know that is because some companies, they don't have dividend policies, and that's a concern as well. And some have stable dividend policies. So this helps us know which model best to use, and also how can we discern whether this is in line with our goals. The third one is comparables also, right? For all models, they'll always have a comparable element at the end. We're always comparing with their peers. I mean, if you don't compare, how would you know how well they'll do, right? So we need to know how well they fare. If let's say company A is doing like all right, like maybe like you give it like a 6 out of 10 performance, and then company B you compare, it's doing like a 9 out of 10 performance. Although company B is slightly higher price, but they show more promise in growth, right? You'll obviously go for company B, right? So I would say the comparables is like the final thing that encapsulates your model and finalizes your thesis, whether to buy, hold, or sell. Next is also, what are the assumptions when projecting our model? Why do you make those assumptions? I don't know if you all have this in poly, but when I'm in uni for the past 3 years, every time I make an assumption for my model, or if I have a reason why I chose this, professors or people will always ask, why? Why do you do this? Why is it like that? Why? Right? I mean, as an analyst, you would ask those questions as well. But I'll say that's the most important, is that you know why you're using it and what are the assumptions. Then followed by the fifth point is time horizon. 3 years, 5 years, how long do you want? Usually general guideline, industry standard is 5 years, but sometimes it's 10 years as well. And number 6, how optimistic is the environment? Like, is the economy doing good, or like how's the environment looking like? Is everybody thinking this is a good stock, or everybody thinking it's bad stock? If it's a good stock, then you also need to stop and ask, is it overhyped? Right? Does it make sense? That'll lead to point 8 as well. But for point 7, growth drivers, you need to find out what's driving the company. That's one of the major guidelines also. What is it that's pushing the company forward, right? If you don't know the growth drivers, this part here, number 7, dismantles everything else. You don't know what's going on. You don't even know what's pushing it, right? So you need to identify the core segments and of a business. Like if you're in food F&B industry, what's like your key element or like your growth driver here? Anybody? Retention rate? Anyone else? Like the number of customers also coming to eat, right? Location, all that. These type of little growth drivers also. You need to find out, and they help you discern whether how your model is going to work. How's your assumption going to work, right? And lastly, trends, like AI, for example. When we look at trends, right, the guideline is generally, when we look at it, we want to know, is it overhyped, and is it logical? Like, is there a proper reason? Like, for example, who here thinks AI is going to be the next big thing? Anybody? Almost everybody would think it's the next big thing, right? I mean, I'm with you on that, right? But if I was a skeptic, right, I would say that there's something in the 80s or 90s called the AI winter. Similar situation. They promised that AI is going to change and revolutionize the industry. But the problem here is that the AI couldn't deliver what it said. I mean, so far we're seeing ChatGPT and all the other AI models deliver what they're saying. But there's also a possibility it might not live up to the potential, right? So these are the type of things you need to ask the trends. Are they overhyped? Are they logical? You know, are they going to repeat the same mistakes as they did in the past? So yeah, these are like the guidelines I have learned when I was interning as well. Yeah. So lastly, when and why do we use it? Having the right tools for the jobs is important. So generally, these are like the reasons why we use DCF. The reason why we use DCF is predictable and it's like stable. It's for stable cash flows. But it's like a Swiss Army knife. You know, it's good at getting the job done, but it might not be very accurate. Then BDM is more for like regular dividend or stipulated dividend policies. This one is then becomes like a more specific tool. Right. There's another model out there. I'll just briefly throw the name. It's called Pharma French model, but that's for arbitrage pricing, which I will not touch. Then there's IPO model, which when companies are preparing an IPO, same thing as a DDM model. It's very specific tool. It's like a specific knife for it. So these are like the general guidelines. And now we'll move on to qualitative analysis. So basically, yes, this is what I've been talking about. If it looks like a duck, sounds like a duck, it probably is a duck, right? So this is what first principles thinking is. We want to discern whether this thing is logical or not, or whether it makes sense. If everything else, like you forget like all the quantitative analysis, at least remember first principles thinking. It applies for every sector or any role that you do, because it always brings back this. It's very basic. It's the core idea. Elon Musk uses it. Many CEOs uses it. I myself, I use it, and I think it's wonderful. It really helps simplify a lot of things, makes it less complex. So basically, we break down assumptions first, right? We see if these assumptions make sense. If they don't make sense, obviously something is wrong, right? After we break down the assumptions, for this case, we're looking at companies. We find out what is driving their demand, their cost, their core value, and profitability. What is exactly their growth drivers, or what is the angle here? Like, what's the pivot that's making them improve, or why we want to buy them, right? And afterwards, when we break it down already, like all these factors, let's say, for example, like maybe an AI company, the thing that's pushing it right now is the AI trend, need for AI, etc. Right? We analyze all these trends and then we put them and we see how it affects the profitability. Obviously, a better AI trend means more profitability, somewhat lah. Right? But the problem here is that when we rebuild it using the fundamental elements, like just the bare bones, the bottom-up approach and all that, and we compare them and we think rationally, we realize that maybe it's not so true. It could be fake. It could be overinflated. And in the long-term sustainability perspective, it may not really last. So yeah, first principles is really boiling it down to like its core elements. You want to bring back yes? Or first principles thinking. Or if it smells like, if it looks like a duck, sounds like a duck, it's probably a duck, is it? Okay. Let me think of how to make it safe for work. Okay, what it means is that sometimes companies will tell you that, let's say I'm Toyota, right? I'm selling you a hydrogen car. The technology exists, it's been around. Then you say that, oh, we're gonna perfect it. It's gonna be good. And how to say, people are gonna love this car, and like it's gonna change the car industry and all that. But the downside is that there's someone published a paper that say that hypothetically, this hasn't happened yet, but hypothetically, let's say you say hydrogen cars don't work, right? And then Toyota just keeps saying that, no, it's not like a hydrogen car, it's something else, it's different, but actually it's still a hydrogen car. That's what it means, is that sometimes you cannot just see what or hear what they say that is rosy. If you know, like, for example, hold on a minute, this is definitely a hydrogen car. It's not what you say it is, like some revolution car. It's still a hydrogen car. It is what it is. Or like the mortgage crisis, the AAA bonds, as I was saying, those like they package the thing. Maybe let me make it more layman. Maybe let's say you got like a 6-day old halibut or 6-day old fish, right? Chop it up, put it in a stew. It's a stew, right? Correct. But if you boil it down to the element, it's still technically like old fish. Still old fish, right? Will you eat it? No, because it's old fish. That's the idea. If it smells funny, it sounds funny, you're not gonna buy it. There's something wrong. You need to find out what is its core elements. That's the whole idea of first principle thinking. Right? You want to find out what exactly it boils down to. So then you'll probably say that, okay, I'm thinking too much from the first method. How can I simplify even more? Like make it such that it makes sense, like total sense. So there's this school of thought. There's multiple razors out there, but for me, I prefer this thing called Occam's razor. So a lot of social science kids, they like to use this, but you can use it in a business aspect. So Occam's razor is basically you're shaving away your assumptions, right? Sometimes like the simplest thesis is the best. It prevents you from overthinking. Like for example, like maybe for the guys, talk to a girl, she never reply you for 3 days. She's probably not interested in you. But you say, no, got all these green flags and all that. But if you shave away those assumptions, she's just not into you. Something like that. Okay. That's the key idea here, is that we're shaving away assumptions. Sometimes our assumptions mislead us because they're not true, right? Like as I was saying, these assumptions, they might not really hold true in reality. So we want to identify the key problems companies face or the equity we're looking at and just really focus on those. The answer with the least amount of assumptions sometimes is the most direct one, and we should take that, right? Then we identify them, obviously, and we compare whether which one sounds more logical, the complex or the simple. If the simple is obviously more straightforward and definitely can answer better and more predictable, like as facts, right? Take the simple answer, right? Sometimes the complex one has too much assumptions and is very speculative, then don't take it. And yeah, you make a choice. At the end of the day, you still have to make a choice. If you feel the complex one is good, just take it. I won't touch this. I think many of you have learned this. Pestle and SWOT. Yeah. SWOT. These are more macro qualitative factors. And Porter's 5 forces. This one is more micro, I would say. your threat of new entrants, your bargaining powers, threat of substitute, and bargaining power suppliers. These type of little things are usually at the end when you start to finalize your whole entire thesis. The other qualitative factor that we look at is also stakeholder analysis. So basically, stakeholder analysis is just you want to find out who has the powers and who are involved. Life cycle analysis is your launch, your early growth and maturity, whether it's a startup, etc. I will just briefly go through. And lastly, before the case study, comparative analysis. So for comparative analysis, usually these are some of the ratios that we use. And we compare them based on these factors: your domicile, your ratios, market cap, very important, and the number and performance of the peers, right? Yeah, obviously you want to get this data, your four places: Yahoo Finance, Bloomberg Terminal if you have access to it, FactSet if you have access to it, and Google is your best friend. And I forgot to mention ChatGPT. Nowadays, ChatGPT can also give you some data and pull it out for you. And how else do we analyze when we have all the data? We want to weigh our options and check if our hypothesis makes sense, and is there any concrete evidence to show where the peers are losing out in the competition. Also, like, are there any events or plans like in their report that they say that, change their positioning, especially within our time horizon with like 5 to 10 years. And most important question to ask yourself, is the intrinsic value of the stock not priced in currently? Means say that, is it undervalued? If it's undervalued, obviously you're gonna buy. That's the best time to buy. So Q&A before the case study, anything? Any questions? No? Okay. Alternatively, when the workshop is done, you can just approach me for questions. So now we'll move on to case studies. Before I continue, maybe you all want to take a QR code. If the QR code doesn't work, please let me know. You can download a very simple DCF model. I would say you probably wouldn't want to use this in a case comp. This is more specific for the workshop. If it's a bit confusing to use, let me know. Okay, everybody got it? Okay. Download. So for today's exercise, for the interest of time, how long do we have right now? Huh?
15 minutes.
15 minutes? Wait, how long? What time does this thing end?
Maybe. Yeah, 6 o'clock.
6 o'clock. Okay. Okay lah, we got 15 minutes. Originally, I wish we had longer time to make you do the exercise, but to keep it brief, let me think, which part of the model should I make you all do? Keep it brief. Where's my mouse? I think to keep it brief, I don't want you all to do the math in the model, right? Maybe you can get some of the numbers, but what I want you to focus on today is the qualitative factors. Why will you buy the stock, right? Obviously, if you're analyzing why buy a stock, you just maybe need to know roughly how much money are they making and are they growing. These are the key components you need to know. So I'll show you 3 companies. You go online, find a report, can be for 1 year, and then you look at how they're performing. Usually every report will show the previous year. So what you need to do is just see whether in a general guideline, is this company worth buying and would you buy it, right? And then maybe when it's done, then I'll maybe ask a few of y'all why you would buy and all that. Cool? Cool? Okay, so the companies that I'll be showing you, first one, you can pick any of these 3 companies, just pick one, right? The first one is BWL. This company has been delisted since last year. Their closing price was $2.49 Sing dollars. So if anybody wants, can take note of the name. The full name of the company is BWL International, Best World International Limited. Next company was a recently IPO company. It was called Next Professional. They do a similar line of business with BWL, but the thing is that just a pointer, they only have one annual report. They just released one only. So you need to think, how can you estimate? Just a brief description of what will you do if you were to buy this stock. And the last one, I think, is the easiest. If you really don't know what to do, just pick Walmart. I'll give you all one of the safest choice. when in doubt, just pick Walmart and then.
I didn't do that before.
I did.
So if you've done this before, good lah. But what I want you to focus on is if you're really very confused, focus on what's your stance? Would you buy? Why would you buy? And is this company growing? That's all. Things only. Very qualitative. The math, right? I think we might have to skip. But using the model, you can go and give it a try at home when you have time. Give it a go, play with it, and then like compare with the analyst reports up there. Most analyst reports are usually published online. You can find them, no issue. So yeah. You guys have about 15 minutes. 15 minutes to do this. So if you want, you can work in groups. If you all work in groups, then I'll ask your group lah. So yeah.
Yeah, because I think a little bit if you
It will be better outside. You ask if I'm not in, I don't what's won't go in. Then you always raise your eye. Yeah, are you in? Always in. I've been in since 2018. The Trump. That is the Singaporean of the president. That will be the Solana. Do you buy Solana recently? This is this going to be oh yeah. No. I didn't know one that is online. It's only but why is I no tech there? It's only support like what is comfortable? Why is comfortable? What do you mean by it itself doesn't take part. There was a portfolios in the what's a portfolio?
Oh, I'm science.
You buy so that's our budget. Oh, so you only like 10%.
There have been portfolio managers who tend to leave licenses to take multi-asset risk. About 5% is
You buy actually.
5%.
5%.
5%.
So previously it was 60-40, a lot of 60-40.
Yeah.
Income from then they split it out. So become 50, depending on the market, 50-40 or commodity.
So that one you want to freeze.
I want to invest in this. Oh yeah, I know. So they give you that okay.
Like recession, like one and get green is like 3,000. Yeah, it's so good. No, the rest of it. Yes, but maybe it's I think different. What's SMO? Or SMO is the same thing. Oh my you see where it's starting. What you got so yeah, it's just a no. That's crazy. That's crazy. 82%, 70%. So basically what you have to do organize your things. Rather than download and I take myself. I don't know what you do over here.
So then next time. No, but changing my
Still got like 6 minutes, but I think can wrap up. Okay, guys. due to the interest of time, I'm going to wrap up. I'll just maybe ask 3 people or 3 groups what stock they do, and then like the answers. Maybe the first group, I can call your fin bros. Come, fin bros.
Gabriel, come.
Okay. Maybe which stock you want to
Take out the EFI report.
So which company you chose?
Walmart.
Walmart. Okay. What's your stance? Will you buy, hold, or sell?
Based on fundamental, currently overvalued.
Okay.
So the intrinsic value that I found was about $80. Now it's currently trading at $83.
Okay.
But there are other factors to consider, like the earnings growth that they have,
Mm-hmm.
investor confidence,
Okay.
and also speculation. Because nowadays, like half the market is like all gambler.
Okay, not wrong, not wrong. What about the qualitative aspect? Like, why do you think the qualitative aspect will link in with like your thesis?
Uh,
Okay.
the qualitative is optimistic.
Optimistic. Okay.
Because, for example, Walmart, they have like sort of move into trying to leverage on AI to like improve their e-commerce
Okay.
and improve their customer experience. So because they went in so early, they kind of have a head start compared to other like discount store companies.
Okay.
Like all those Dollar Tree that's like
So your stance is to buy or hold? Buy. Okay. Even though you feel it's overvalued.
but you still buy because the other supporting factors outweigh the.
Okay, actually that's a good analysis. Yeah, I think that's wonderful. Maybe one question you don't have to answer me. Maybe you should think about also is how long are you buying it for? So, because that can affect your time horizon can affect how you view it. Okay,
Wait
thank
for
you.
the next earnings.
Thank you for sharing. Maybe you can clap. Everybody give a round of applause. Next group. Did you guys do or you guys want to try? Okay, yeah. So which company you guys look at?
You actually did this.
Yeah, fine numbers. Anybody else did? Who else did any other company besides Walmart? Or everybody did Walmart? Okay, never mind. I think most of you do Walmart, but maybe ask for 1%. The group at the center, you did Walmart, is it? Or which company? Next, what is your stance?
That part still only for similar.
Okay, yeah, it's hard to say. That's all right.
But I honestly I'll just wait on it. Like maybe if there's more like the data then like but based on what I see right now, revenue is decreasing. I'll people go for it.
The revenue decrease, therefore you wouldn't go.
But I would say that building factors will be that the price ratio is and is also low. Like lower than
Okay, maybe my question to you then is if E is low, price book is low, revenue is decreasing, why would you still hold?
but because it's decreased by just like deal. So
Okay.
and with limited data is hard to tell, so I would just wait for
Okay. Okay, I think that's a good one. Now I think everybody can give him a round of applause, right? Maybe last one. Don't know if everyone wants to share. No, I'm gonna pick y'all. Maybe there's the two gentlemen there. What do you guys choose?
Walmart.
Walmart. What's your stance?
Sell.
Why sell? Okay.
So it is what. So for its strength, it has a very strong brand recognition. Highest percentage contributed largest company by revenue. And for its businesses, it has a return rate of 0.89%. But the average S&P 500 company has 2.5%. And its year-over-year growth for the past 5 years is around 5%, which is much lower compared to the market. I use S&P 500, it's much lower than S&P 500.
Okay.
So then the opportunities would be expansion into e-commerce, where they started doing online grocery shopping. Diversification and expansion in outside the US.
Expansion outside US. So if they're expanding outside US, where are they expanding? You know where?
Maybe Mexico or Canada.
If I'm not wrong, I think Walmart I'm also push. I'm not wrong.
I think that's Costco.
There's Costco or Walmart? I can't remember.
Maybe both.
Maybe both, right? This I need to check. I remember I did read somewhere it was they were expanding in China.
And then
But if they're expanding, then why would you sell? That's my question.
because it take too long before you actually start with them yourself.
What do you mean by take too long? What's your time horizon then?
I haven't thought about it yet, but because right now the company is growing, but at a very slow rate. And they also have a lot of live businesses as well. Helping them. Then like it's take too long before I get to see different. And some of the trends are competition like Target and Costco, and a decrease in purchasing power of their largest demographic, which is the middle class. But I read an article about how majority of the demographic is now middle class. And then because of increase in inflation, they have started to seek other
Alternatives.
alternatives.
Okay. I can understand teachers. Everybody give a round of applause. I think from that. Maybe the two ladies at the back. No, don't want to share. Okay. We'll pause you. I think can wrap up. So, yeah. I'm going to wrap up right now. But before I wrap up, I just have a little gift for you guys. So this was what I've been talking about. So these are some of the framework samples I've learned from Professor NYU Stern. It's very long, it's very complicated. I can't go through all of them. When you have time, please go and take a look. Sometimes he explains it and it's a bit disjointed. You maybe need to go and Google it yourself. But what he does is that some of these models he uses in his lecture. Maybe a brief overview about this professor. He was a visiting lecturer in Berkeley, and now he's teaching in NYU Stern Business. So NYU Stern Business is actually one of the hardest business schools to also get into. The acceptance rate for NYU Stern, for those who are interested in trying to go in, is 8%. 8% acceptance rate. If you can get in, it's good. So I highly recommend. Yeah, his frameworks are very broad, and he explains to you like how each one to use and all that. So I say it's very useful. If you're going for a case comm, you can use his models, but obviously don't let the judges know you use lah. If not, they're gonna like ask a lot of questions and give you a lot of problems. Yeah, run LinkedIn also can. All right. With that, enjoy your Chinese New Year. I hope you guys have a good one, and I hope this session was good. Hopefully, can see you all again, and thank you.